We'll now cover Section 7, Merger Analysis, and Section 7 has two subsections, Target Company Valuation and Bid Evaluation. As this name implies, the point here is to figure out how much is the target worth. And we will use three methods, where at least the first method should be quite familiar and the other two methods should be relatively familiar. Let's start with the discounted cash flow method. With this method, what we do is estimate the free cash flows of the company. And when we talk about free cash flows here, we are talking about the free cash flow to firm. So the cash flow that is available to both debt holders and equity holders. And we are going to come up with free cash flows up till a certain terminal year. So if this is time 0, this is some terminal year. So the free cash flow every year till the terminal year. Then we will come up with a valuation at the terminal year and discount back. So discount back all these free cash flows and discount this terminal value. So clearly two questions emerge. The first question is, how do we calculate the free cash flows for every period? And the second question is, how do we determine the terminal value? Let's look at the free cash flow question first. This is material that we'll see in a lot of detail in equity. In fact, there is a full reading on free cash flows, which is why I don't think you will have a detailed question on this material in the corporate finance segment of the course, but it is part of the reading, so I'm going to touch on what I believe are the relatively significant points. When you are looking at the financial statements of a company, you obviously will be able to figure out the net income, and we are then going to make some adjustments to net income to come up with the free cash flow to firm. This is a fairly elaborate discussion in the curriculum, and I am just focusing on the critical aspect of that discussion. This is net income, which is the money that is available to shareholders. And since we are taking both a shareholder and debt holder perspective, what we do is add back interest. So net interest after tax is added back, and this number then is called the unlevered net income. You can think of this as the money that is available to both bond holders and debt holders. Then this is something that will bring back pleasant memories of a reading called Income Taxes at Level 1, where if you recall that many large companies, because of different depreciation methods on the financial state versus the tax statement, will have deferred tax liabilities. So when there is an increase in a deferred tax liability, an increase in a liability is a source of cash. So if in this particular example we have the deferred tax liability going up, then you add this number to your income. That will give you what is called NOPLAT. Now, don't get hung up about the fact that these are taxes or they are deferred taxes. Just think of it as a liability. So increase in liability is a source of cash. You are paying less taxes than you should be paying, which effectively is a source of cash. Then you add non-cash charges, and in the particular example discussed in the curriculum, the only non-cash charge is depreciation. Since we are calculating a cash flow, we add back depreciation. Then if there is a net working capital investment, which is calculated by coming up with the change in net working capital, current assets minus current liabilities, that is given in this particular discussion in the curriculum, that is 455. Is this added or subtracted? It is subtracted because it is an outflow of cash, money spent on working capital. What about capital expenditures? This is also subtracted because it is money spent on capital equipment. And these numbers are all given in the excerpts in the curriculum. And you then come up with free cash flow. So you use this method to come up with free cash flows for every year until the terminal year. Then what is the second question? The second question is coming up with the terminal value, and there are two ways of coming up with the terminal value. One is to use the Gordon growth model. So you say that, look, if this is time t, the terminal year, you come up with your free cash flow for the terminal year and assume that after the terminal year, the free cash flow will grow at a perpetual rate of G. So if, let's just say that your free cash flow for this year is 100, and 100 will grow at a rate of say 3%, then what is the terminal value over here? It is equal to the cash flow at the end of this period, which is 100 into 1 plus G, or 3%, divided by cost of capital. And why do we use cost of capital and not cost of equity? Because we are looking at the cash flow to the whole firm, which includes debt holders and equity holders. So you need to use the weighted average cost of capital. So you divide by WACC minus G. Again, this is just Gordon growth model applied to free cash flows. This will give you the terminal value here at time t, and you discount that back. The second method is to apply a valuation multiple. And what you do here is you say that, look, at time t, for this last period, if my free cash flow is 100, and in my industry I expect the multiple to be 10, then you apply the multiple and you come up with a value at time t. And again, this is material that you will see in a lot more detail in equity. What is the final step? The final step is to take the valuation, the terminal value, come up with the present value, take all the free cash flows and come up with the present value, and this gives you the value of the target. What are the advantages and disadvantages of the discounted cash flow analysis? So here are the advantages. Expected change in target companies' cash flows, which might come about because of synergies or because of any other cross-selling that you might do. So this particular model allows you to take in those, to consider those factors. And you will see that some of the other models that we use do not make it that easy. An estimate of the intrinsic value based on forecasted fundamentals is provided by this model. That's another advantage. Any changes in assumptions and estimates can be incorporated by customizing and modifying the model. What are the disadvantages? Difficult to apply when free cash flows do not align with profitability in the first stage. Let's say that you have a young company which is profitable, but it is making lots of investments. Then what will the free cash flows be? For the next few years, the free cash flow will be negative, even though it is profitable from an accounting perspective. But if it is making investments, then from a cash flow perspective, we'll have negative free cash flow. So that makes it a little hard to estimate. It is easy to come up with Excel spreadsheets with cash flows, but it is much harder to come up with realistic or correct cash flows. Estimates of discount rates can change over time. The company might become more risky, less risky, market interest rates can change, so discount rates can change. And the terminal value is very sensitive to assumptions made. Again, this is something you'll see in equity, but if your growth rate assumption changes from 3% to 2%, that will have a huge impact on the terminal value. Next, we look at the comparable company analysis. I'll define the process and then work you through an example. The context is that you are trying to come up with the value of a target company T. So the first thing you do is you identify a set of companies that are similar to T, from the same industry, maybe similar capital structure. So let's say you identify 1, 2, 3 companies that are quite similar. Then you calculate the relative value measures such as the enterprise value to EBIT, price to cash flow, price to sales, etc. So you come up with the multiples for these 3 companies. Let us say that for simplicity, right now we'll focus on the PE ratio. And let's say that on average, the PE ratio for our comparable companies is equal to 10. And let us say that the earnings for our target company equal 200. Then based on this method, what is the value? The value of the target will simply be 200 into 10, which is 2000. Are you done? Not quite, because when you are talking about mergers and acquisitions, typically the acquirer needs to pay a premium. So what do? You have to determine that takeover premium. This is the amount that the acquiring company needs to pay above the market price. How do you come up with that value? You look at other transactions, similar transactions that have taken place, and based on those transactions, you try to come up with the premium. In percentage terms, the premium is equal to the deal price. So DP stands for deal price minus SP, which is the stock price divided by the stock price. Let us apply this process, and we'll do so using example 8. I have skipped the text, but I'll set the context. You are an analyst. You are trying to figure out the price that should be paid for company T. You identify 3 comparables, comparable 1, 2, and 3. The stock price, EPS, etc. All this data is given for the 3 companies. The first thing that you do is you come up with the relevant ratios. So you believe that for valuation purposes, these are the 3 important ratios to use. Can you come up with the PE, P to cash flow for all 3 companies? You can. Then you can also come up with the mean. So you do not believe that any one company is particularly indicative of your target company, so you take the average. So for each of these ratios, you have an average number. Then you come to your target company. This is the information related to the target company. You have the earnings per share, the cash flow, book value, sales per share. And then you apply the average PE and you come up with the estimated price based on PE. Similarly, you look at the target company's cash flow, you look at the average price to cash flow, and you come up with what the stock value should be based on this ratio, and so on. You have 4 different numbers. Which one to use? If you don't feel particularly strongly about any of these, then you just take the average. Are we done? Not quite. We still need to apply the premium. So we look at similar transactions, and in the real world this is hard, but in the exam world it is straightforward, where you will be told that there is a certain takeover premium. Let's say that the takeover premium is 22.9%. Then you simply take 33.47, add on the premium, and then this is the deal price. What are the advantages, disadvantages? So the advantages first. This method provides a reasonable approximation of a target company's value relative to similar companies in the market. Most of the required data are readily available. Unlike DCF method, the estimate of value are derived directly from the market. What did we do in DCF? There we had to make projections about cash flows and so on, but here we are taking market values. Disadvantages: sensitive to market mispricing, difficulty in incorporation of any specific plan for the target may lead to inaccuracy. The point here is this: very often with mergers and acquisitions, there is going to be some synergy, which is why the acquisition is happening in the first place. So let's say that due to that synergy, there'll be a cost saving. How do you model that over here? Difficult. Can you model that with free cash flow? There it is, easier to model. Another disadvantage is that this process yields a market estimated fair stock price for the target company, for which an analyst must additionally estimate a fair premium, and coming up with that premium is very difficult. Data for past premiums may not be easily available. Alright, finally we talk about the comparable transaction analysis. This is quite testable because your examiner might try to understand whether you can catch the difference between comparable company analysis versus comparable transaction analysis. Pay careful attention to the names. On the previous slide, we talked about comparable companies. Now we are actually looking at comparable transactions. So as before, we will look at other companies, but now we are looking at actual merger acquisition transactions that took place. So in those transactions, we can see what was the PE built into that transaction. So the deal price relative to earnings of the target, the deal price relative to cash flow, and so on. As before, we look at the mean. If we have 4 transactions, then we look at the mean numbers. But do we need to add a takeover premium? We do not need to add the takeover premium because the premium is built into the deal price. So let's look at example 9. Again, you are trying to come up with the value of target company T. Specifically, we want to come up with the deal price. We find these 3 comparables. Now, the data given over here, the share price, etc., is this based on market price or is this the transaction price? So these are now transaction prices. So these ratios are all based on transaction prices. We take the mean PE, the mean price to cash flow, and so on. Then we look at our target company. So that has a given earnings per share, a given cash flow per share. You multiply this number by the mean, and you have the estimated takeover value based on the PE ratio, and you do the same with the other ratios. Now let's say that of all these ratios, you believe that the cash flow per share ratio is going to be most indicative of what the value should be. If you have more confidence in this ratio, then what can you do? You can then take a weighted average. Rather than simply taking an average of these numbers, you can assign weights. And if you had most confidence in the cash flow related ratio, then you put a 40% weightage associated with cash flow, and you come up with a weighted estimate. Advantages, disadvantages. Not necessary to separately estimate takeover premiums because the premiums are built into the prices. Takeover value estimates come directly from values that were recently established in the market. Use of prices established through other recent transactions reduces litigation risk for both companies, board of directors, and managers regarding the merger transactions pricing. Disadvantages. There is a risk that the real takeover values in past transactions were not accurate. There may not be any comparable transactions to use to calculate the takeover. So I would almost say that if this is not there, then the whole method goes out of the window. Analysis may be inaccurate as it is difficult for the analysts to incorporate specific plans for the target. Notice that the advantages, disadvantages of the transaction approach and the comparable company approach are almost similar. The only difference is that with the transaction approach, you don't have to worry about the premium. All right, section 7.2, bid evaluation. In my judgment, this is the most important subsection of this particular reading. And if you get something on mergers and acquisitions, I think, very high probability that you will see this. Now, let's say that the acquirer and the target both agree in principle that the market value of the target should be $10 per share. Does the story end there? Probably not, because there will be some synergies associated with the merger, and both parties, the acquirer and the target, will try to get as much of that share of the synergy as possible. In simpler terms, the acquirer will try to pay as little as possible, and the target will try to receive as much as possible. Okay, so let's read this excerpt from the curriculum and then understand some very important definitions. Even if both the acquirer and target separately agree on the target company's underlying value, the acquirer will want to pay the lowest price possible while the target will negotiate for the highest price possible. generally the acquirer will have to pay a premium, which is a gain for the target shareholder. If the acquirer is not paying any premium, then what's in it for the target? So there needs to be a premium. All right, now let's say that a certain premium is paid. Then what is the benefit to the target shareholder? If the value of the firm, of the target entity, before any discussion or before any rumors related to the takeover emerged, let's say that value is VT. And then after the takeover discussion begins, then the price of the target company starts going up. So let's say the price goes up to PT. What is the target company shareholders gain because of this potential takeover? It is PT minus VT. A point that I've made here in brackets on something that is testable. Let's say that before any takeover discussion emerged, the value of the target company share was 100. Then as maybe some news leaked that there is a potential takeover and the stock price starts going up, then let's say that 1 week later, after the rumors go out, the stock price becomes 110. When we talk about the shareholders' gain, do we use a base value of 100 or a base value of 110? The answer is we use the base value of 100, because the increase from 100 to 110 was based on the speculation or the rumors. All right, so this is the gain or the premium for the target shareholder. What about the acquirer's gain? Why is the acquirer trying to take over the target? Probably because there are some synergies, otherwise it would not make any sense. Let's say the value of the synergies is given by S. So if I make a very simple example, if the value of T, so value of the target before any discussion was 100, and let's say that the price that is being paid is 110. So what is the target shareholder's gain? It is 10. But let's say that the synergies from this transaction are 30. So the present value of the benefits created by the merger equals 30. Of that 30, how much is going to the target shareholders? 10. So what is the acquirer's gain? It is 30 minus 10, which is 20. Then the next point is, after the merger, what's the value of the firm? And that is given over here, VA with an asterisk. This refers to the value of the firm after the merger. That is equal to the value of the acquirer before the merger. Let's say that the value of the acquirer before the merger is 200, plus the value of the target company before the merger, that let's say is 100, and then plus S. S stands for synergies. If the synergies are 30, then we add that, and then we subtract the cash payment that is made to the target. Where is that cash payment coming from? It's coming from the coffers of the acquiring company. So let's say that the cash payment is, let's say 10, whatever that might be, you subtract that. When you go through example 10 with me now, the concept that I just talked about will hopefully become clear. I want you to try this first, and again I would argue that this is perhaps the most important example in this reading, so make sure you understand it well. So do it on your own, and then I will go over the solution. So here is what you do. First part is to actually just understand what is going on. It is not a coincidence that one company starts with A, that's the acquiring company, the other company starts with T, that's the target company. You are advising the target company. There are three possible options, and you need to figure out which option will be most beneficial to your client, T. You are told that the NPV of the post-merger economies of scale is 90 million, and a mistake that most people make is they ignore this, which is a mistake we should not make. Let's look at alternative one, where the acquirer pays your client T $12 per share in cash. How much money does your client get? Obviously, you will go through the three alternatives and pick the one where your client gets the most money. $12 per share, and how many shares outstanding? 30 million. So in alternative A, your client gets 12 times 30 million, which is 360 million. This is the easy one. What about alternative 2? The acquirer will give your target company T 0.8 shares of Adagio per share of Tantalus stock. So the first thing that you now need to do is figure out what the value of Adagio stock will be post merger or post acquisition. And I discussed the formula with you earlier. The value post merger is going to be equal to value of A, the acquirer, which is 1125, plus the value of the target, which is 300, plus the synergies, which is given 90, and minus what? Minus 0, because no cash payment is being made. So what is the overall value? 1515. This is the total value of the firm, but how many shares outstanding do we have now? Originally, A had 75 outstanding, but to buy T, the company had to issue more shares. Right? How many more shares did A have to issue? So it had to issue 24 million more shares. Where is that 24 coming from? 0.8. So 0.8 into 30, because for every share of T, 0.8 shares of A are needed. So 0.8 into 30 million is 24 million. So after issuing 24 million shares, what is the total number of shares of this new larger entity? So it is 75 plus 24, which is 99 million shares. This is the total value. This is the number of shares. So what is the share price of the new entity? It is 1515 divided by 99, which is 15.30. So this is the value of the entity after the acquisition. Then you need to figure out how much your client is going to get. So your client is getting 0.8 shares of this. Now we go back to a formula that we saw earlier. So we have the conversion ratio, which is 0.8, multiplied by 15.30, multiplied by the number of shares of T, which is 30 million, and this will give you 367.27. So what is the premium here that your client is getting?
7.27.
The premium that your client is getting relative to the original value is actually 67.27. Is this premium more than the premium over here? Here the premium was 360 minus 300, which is 60. So clearly option 2 is better than 1. But we are not done yet, because we also have a third alternative, and this fully utilizes the formula that I just asked you to learn. Here we have a mixed offer, and notice that this connects with material that we have discussed earlier also. With this mixed offer, what is the new value of the larger entity? It is again that value of A asterisk is 1125 plus 300 plus the synergies of 90, but now a cash payment is being made. That cash payment is 180. So what is the value? It is 1335. How many shares are issued in this particular case? 0.4 into 30. So the total number of shares will be 0.4, which is our conversion ratio into 30 plus the original 75 million. So this will give us 87 million shares. What is the share price in this case now? It is 15.34. How much money will your client get if we go with alternative 3? Your client will get 6 multiplied by 30 million, because that's the number of shares, plus based on 0.4 shares, what do we do here? We do 0.4 into 15.34, this number into 30 million. When you do this calculation, you get 364 point something, right? So 364 point something. This is a little less than what you had with alternative 2. And therefore, you will advise your client to go with alternative 2. And again, I am repeating myself, but extremely important. And I'd say that it's the most testable concept in this reading. All right. We have done the difficult material, now a couple of relatively straightforward sections. When there is merger and acquisition activity, who benefits? Several studies have been done, and simplistically, this is what studies show. In the short term, on average, target shareholders reap a 30% premium over pre-announcement price. So, looks like generally the target company shareholders do well, at least in the short run. The acquirer's price often falls between 1% and 3%. So by and large, the market perceives this as good news for the target. Why? Mostly because the acquirers tend to overpay. What happens in the long term? And again, this is based on empirical studies. Average returns to acquiring companies subsequent to merger transactions are negative 4.3%. with about 61% of acquirers lagging their industry peers, so doing worse than industry peers. So at least if we go with historical evidence, unless you have a really compelling reason to acquire another company, you should not go for it. And if you are a target company shareholder, then you let the price go up and sell quickly. Okay, that is, unless you have good reasons to believe otherwise, that is what this historical data seems to be suggesting. There are still characteristics of certain merger and acquisition deals that create value, and you should know this, because if you are evaluating a transaction, then how do you figure out whether value is really being created? These are the characteristics to look for. If the buyer is strong, then that is a positive. Transaction premiums are low. That means that the buyer is not overpaying, or the acquirer is not overpaying. Related to that is relatively low number of bidders. If there is a high number of bidders, then what will happen? Then the chance of a price war exists, and if a price war is happening, then the premiums will be high. Is this good for someone? It's very good for the target, not so good for the acquirer. Also, if you are an analyst, you should look at the market reaction. If the initial market reaction is favorable, that's a positive sign. Otherwise, it's a negative sign. All right. Corporate restructuring. This whole discussion has largely been based on A acquiring B and becoming bigger. So mergers, acquisitions. But what about the other way around? Do large companies sometimes split up into smaller companies? That happens. That is called restructuring. Or another term that is often used is divestiture. This is where a company becomes smaller by selling or liquidating or spinning off a division or a subsidiary. Now, before I go into some specific kinds of divestitures, I'll just make a general remark. At the start of this lecture, I talked about example 2 that discusses the fact that, at least in the United States and probably in other parts of the world also, merger and acquisition activity goes in waves. So there are periods when mergers and acquisitions are very popular. What also happens is corporate restructuring also happens in waves. So there are times when it is popular to have mergers and acquisitions. Then there'll be other times when your consultants will advise that focus on core competence, focus on what you are good at, spin off divisions that are not making money, spin off divisions where you don't really have synergies, then there will be divestitures. So if you look at the last century, sometimes mergers and acquisition activity is up, other times divestiture activity is up. And the good thing for investment bankers and financial analysts is that they can make money in both markets. All right, now, what are some different kinds of divestitures? One is an equity carve-out. Here, a new legal entity is created and new shares are issued to new shareholders. So you have a large company, it spins off this entity, and this entity then, has its own shares issued and new shareholders. Another is a spin-off, where again you have a large company initially, it spins off a group, and the original shareholders then have shares in the original company and the new spin-off company. Okay, so if you were a shareholder here, after this spin-off, you will be the proud shareholder of that original company and this new company. Probably the value of your share over here will be less. And if you simply look at a pure transaction without any synergies, then the sum of the value should be roughly the same. A split off is similar. Here shareholders get shares in new company in exchange for shares from the parent company. And then finally you can have a liquidation where a given set of assets is sold off. What are the reasons for divestiture? A big one would be change in strategic focus. So for example, you are an auto company and you had a financing wing, and now you decide to stop the financing business. Your focus now is just on selling cars. You might divest or you might sell off the financing division. Not probably a great example because very often it is the financing division that makes the most money, but just as an example. A poor fit, you figure out that a particular business that you bought 5 years ago no longer fits with the business, so you spin it off. Reverse synergy, you figure out that, if you are big company A, you have this division B, and, rather than adding value to A, it is hurting your business. Another silly example, let's say you are in the automotive industry. A is known to make luxury cars, so hits the high end of the spectrum, and then this division makes low-end cars. And you figure out that because of this low-end division, that is having a negative impact on your core business. The perception now is not that you are a luxury car maker. So then what you might do is spin off B and just focus on your core market segment. Financial or cash flow needs, a company is running into financial issues, so it sells off a division, and with that money it tries to at least keep its main business going. All right, long reading, let me just summarize the most important points. We categorize mergers in several different ways, and I think the most important categorization is to recognize that you can have horizontal mergers, vertical mergers, and conglomerates. Then we talked about motivations for merger and acquisition activity. The big motivation is synergy. And you can have synergy through economies of scale, you can have synergy through, maybe higher market power and higher prices. So understand all the motivations, and in fact, more than understanding is the easy part, you need to try and remember the list of motivations. Then another item that is easy conceptually but difficult in terms of remembering is the fact that your industry will have a life cycle. And at each stage of the life cycle, there are particular kinds of acquisitions that are more likely to happen. And for each of those acquisitions, there are certain motivations. So you need to memorize that. Then we talked about forms of acquisitions. the two major forms. One was where you buy the shares or the stock of the target company. The other is where you buy the assets. And then I shared a table from the curriculum that talks about characteristics of both those forms of acquisition. Methods of payments: you could either pay in cash, or you can pay in shares, or you could have a mixed offering, which is a combination of the two. Attitude of target management: this is fairly straightforward. Either the target company management is friendly, there you negotiate, do your due diligence, and then try to seal the deal, or you might have unfriendly management, in which case we would call this a hostile takeover. We then talked about pre and post takeover mechanisms. Again, this is something you need to learn. So in the pre-takeover, you had items like the poison pill and so on. In the post-takeover, we had items such as taking on more leverage. What you need to do is, again, memorize that list. Then antitrust analysis and HHI. If there is a situation where the level of competition in an industry is being compromised, so the level of competition is coming down substantially, in other words, the industry is becoming more concentrated, then there is a high likelihood of the regulator stepping in. We then talked about valuation of the target company. So three main methods: the discounted cash flow method, then the comparable company method, and comparable transaction methods. You need to understand these methods and the pros and cons of each. This was the most important formula in the reading, where we say that the value of the company after acquisition is equal to the value of the acquirer before acquisition, plus the value of the target before acquisition, plus synergies, minus the actual cash paid by the acquirer to the target shareholders. Notice that it's being paid to the target shareholders, so this money then is no more part of the company. The target shareholders can take the money and go spend it on a big party or whatever, so it's not part of the new entity. That's why it is a minus. Okay, characteristics of M&A transactions which create value. We talked about 3 or 4 characteristics. The buyer needs to be strong, and the buyer should not be overpaying. Those are the most important items. Then we talked about divestitures. This is where large companies become smaller, and then ways of doing that include equity carve-outs, spin-offs, split-offs, and liquidations. Then finally, we talked about some reasons for restructuring. The big one often is to focus on the core competence of a particular entity. As always, I want you to read the summary, review the learning objectives. I've gone over most of the examples. Example 10 was the most important one. Do the practice problems in the reading, and if you have time, then do questions from other sources. That is it.